I'm Taylor Nissi from Pleasant Street Wealth Advisors. At Pleasant Street Wealth Advisors, we're on a mission to help more people have confidence, peace of mind, and clarity in their financial life. Effective estate planning is one way we help our clients have peace of mind, knowing that their loved ones will be taken care of in the event that they're no longer here. At Pleasant Street, we define estate planning as assisting our clients to transfer their wealth to the people and causes they care about in the most efficient manner possible. Today, I'm joined by Shane Kimmel from Ash Brokerage. Shane is part of our advanced planning team, and we bring him into client relationships to provide his knowledge and expertise around topics like estate planning. Shane, thank you so much for being here today.
Thank you for having me.
Yeah. For folks who are not familiar with estate taxes, or what some people call the inheritance tax, can you give us a quick overview?
Of course. One thing too to mention, being proactive on this issue. This is something that Pleasant Street Wealth is one of the few firms that we work with that are actually being proactive on this issue, because it's something that a lot of people don't think is going to affect them, or it's not something they have to worry about yet. It's for something to worry about in the future. Where in essence, what this looks at is there's a state version of an estate tax and a federal version, where the federal version is what most people think of, and that's what they don't think affects them. But there are certain states, 13 in particular, that have their own state estate tax. That is something that we wanted to discuss today.
Thanks, Shane. And so those, what are some of those misconceptions? I think you touched on the state tax versus the federal. What are some of the other things that might be changing with these tax rates in the future that people might not be aware of?
Yeah, the biggest thing is just being aware of the state that you live in. So a state that has their own estate tax, not the federal, states like Massachusetts, Oregon, Rhode Island, Washington, Minnesota, Vermont, Connecticut, Illinois, Maryland, Hawaii, Washington, D.C., Maine, and New York. And if it sounds like the Northeast, it's primarily the Northeast. The thing too to be aware of, that your own particular state, as opposed to federal, a state like Massachusetts, you hit your state estate tax once you cross over $1 million of assets, where a state like New York, currently it's over $7 million. There's also states that have an inheritance tax as opposed to an estate tax, where those two words might be interchangeable. They're similar but different, where a state is being taxed at the estate level. So when a spouse passes away and it goes through probate, you have 9 months to pay that tax. That is where that is due. Where an inheritance tax, it's the people who receive that. So whether that is loved ones, children, whoever it might be, those states are Iowa, Kentucky, Nebraska, New Jersey, Pennsylvania, and Maryland. And they all have different rates, where again, Massachusetts is a state that is most commonly brought up for estate planning attorneys, because that threshold starts at 1 million. And it continues to grow, just like income. The more income you make, the higher the rate is, the higher you pay. In essence, the more you pay to the state. And that's something why you want to make sure you're addressing this as soon as possible, especially for highly appreciating assets.
That's really helpful for folks to understand. Would you be able to walk us through a couple of case studies? For Massachusetts in particular, we work with a lot of folks in Massachusetts in the Northeast. I think it would be helpful to kind of see this in action. I think a lot of people might think, oh, I only need to worry about estate planning at the end of life, or once I have children, or different situations like that. But I think it's really interesting for people to think about, well, once my net worth crosses $1 million, if I live in Massachusetts, I should really be thinking about this. So it'd be great to see some examples.
Yeah, of course. And again, this is just one of the things that Pleasant Street Wealth is doing that not many others are doing. They're not having this discussion or even showing what the impact could be, because this is something that Taylor and his team can put together with the help of our team, just to show you what's my potential issue, what could be there, a what if scenario, where it's always great to talk about in theory, but to see and run a scenario of yourself and your family, and that's really what you're working your whole life for. You don't want to lose a chunk of that, and worst of all, unexpectedly lose it, where you think more is being passed on to the next generation, or where you choose it to be than not. So if you see here on my screen, here's an example of just a 50-year-old couple. They have $6 million of assets, and what we broke that down was because real estate got a pretty big boom from the COVID bump. We assume that is going to tame a little bit down to 3.5%. Where equities, securities, other appreciating assets are going to be at 7%. So what this talks about up front here, this little blurb, is just saying that the federal estate tax currently is at just under $13 million per person. So in this example, this is where most people will think when you break it down, I'm not going to have an issue till later, because you can see all the green's the money you keep, red is the money that you're going to go and give to a state or the federal government or combination of the two. So the estimated tax at death for a 50-year-old couple is going to be about $28.5 million. So it sounds like a big number on our projection. Again, 50-year-old couple, we're assuming that 2023, should something happen to them, if you don't have the estate tax issue discussion with Taylor and his team, just looking at it, you might be on the hook, or your state might have to pay over $500,000 to the state of Massachusetts just by being worth $6 million. Not a likely scenario that two 50-year-olds would pass away, but it is a possibility and just something to be aware of. Now, breaking down these numbers, how did we get to that massive number in the beginning? If you look currently, the exemption is the highest it's ever been. 20 plus years ago, it wasn't even at $1 million. It's currently almost at 26 million and is going to get there using this assumption, which is at the Fed's level of 2%. We've seen inflation grow past that with the unified credit, but we just want to add a little conservative nature to it, assuming that exemption grows at 2% and that the government doesn't need all this extra money to pay down all of the extra funding and spending that they implemented. So if you can see, looking at 2025 versus 2026, if someone passed away on December 31st, 2025 versus January 1st, 2026, they are going to owe several $1 million more in taxes by that 1 day difference. And that's one of the things it makes sense to have this planning discussion early, to at least be aware of those risks that could be out there, because that was one thing that was being discussed back at the end of 2021 that fell apart at the 11th hour, was lowering it back to that lower number in 2026, moving the date up. That all said, if you're looking at the growth here of a $6 million worth, again, real estate, $2 million, which got a little COVID bump, and securities that are going to continue to hopefully appreciate. If you just look at that as a growth metric, you'll see that currently that couple, again, would have over $500,000 due to the state of Massachusetts. And if they live for another 30 years, if you look 2023 all the way down to 2053, they would have an accumulated net worth of almost 27 million. And now they're paying almost as much in the federal level as they are in the state. And if you continue to grow that further, life expectancy mid to late 80s, you can see there is a huge tax bill due. So that's one of the reasons why we want to have this brought up now to discuss, because if it's not something that you're bringing up, and that's why Pleasant Street Wealth wanted to bring this to your attention, there's no action is an action. We want to make sure that you're aware of this as soon as we possibly can, because the sooner you can get any wealth, especially greatly appreciating wealth, out of your name to grow in a separate vehicle or separate plan, that is a way to help defer this tax, or at least minimize the potential tax risk in the future.
Yeah, and I think Shane brings up some really good points here. Number one, the numbers sort of speak for themselves, and a lot of people, again, probably don't think this applies to them. And if you live in a state like Massachusetts or New York, you should be proactively addressing this and talking to your accountant, your estate attorneys, your advisors, speaking to people like Shane to help go through some of the advanced planning options here. So Shane, if people are watching this and thinking, I need to start considering strategies here, what are some of the common strategies that folks would use to address the type of estate planning we're talking about, the problem that we're talking about?
Yeah, one of the most common used ones is gifting, and especially gifting into a trust. Because if you do that with a trust, you can not only set the terms of that trust, but you can dictate how much goes in and still have control of those assets while you're alive. But then at that point, determine them out of your name and have them grow in a tax efficient manner. One of those things too, if you've ever spoken to an estate planning attorney, it's kind of like Taylor and I, who have young kids. Whenever you go somewhere, you don't know how underprepared you were, not bring an extra outfit or an extra set of diapers or even the kids' food. But if you forget one day or even one meal or one outfit, you know how underprepared you were. So that's why we want to have this discussion, where when you're gifting those assets out of your name, that is being overprepared, where the worst thing you're going to be is overprepared is you did a little too much planning. But if you didn't do enough planning, that's one thing where you know pretty quickly. So gifting is one of the most common ones, and there's several different trusts you can create. once it's in the trust, a lot of people will also take advantage of using insurance because other people, not just yourselves, are going to have this issue. So if you risk pool that together, which is how all insurance works, you can pay cents on the dollar to leverage up what's there and then pass on more of your wealth to your family, to loved ones, to whomever you'd like, and not pay as much to the state. So that's a a very popular strategy to use. And on top of that, all you're doing is just adding extra liquidity to your state because, like everything, death and taxes are the two things that are guaranteed in life. You just want to make sure that you're not paying as much in taxes as possible if there's a way to leverage it sooner than later.
Yeah, I agree with everything Shane said. In our firm, we often use gifting and insurance strategies to help, our clients achieve their legacy goals and minimize the, tax bite on their estates. So if you want to connect with us, on the next screen, you'll see all of our contact info. We appreciate you tuning in. Shane, I really appreciate you joining us and sharing your knowledge, expertise, and walking us through those scenarios. I hope you have a wonderful rest of the day.
Thanks all.